Hi everyone, so now we're going to review two of the problems at the end of the chapter. Now please don't judge me on my artistic and PowerPoint making ability. This presentation is meant to give you the answers and review them. So in P1-16A we have Morrissey & Brown of Sydney as merchandising company that is the sole distributor of a product that is increasing in popularity among Australian consumers. The company's income statement for 3 most recent months follows. Okay, so we have July, August, and September. Identify each of the company's expenses, including cost of goods sold, as either being variable, fixed, or mixed. So you can see those amounts in front of us. The cost of goods sold would be variable. The advertising expense is fixed. Shipping expense is mixed. Salaries and commission are mixed. Okay, there's a fixed portion and a variable portion. Insurance expense fixed, so that doesn't vary with production, and neither does depreciation. Let's move on to part 2. In part 2, it says using the high-low method, separate each mixed expense into variable and fixed elements. So the first, there's shipping expense, salaries and commissions expense. I believe those were our only two. So the first thing we want to do is determine their variable. Remember how we do this. We take the change in cost, high and low, and the change in units, high and low. So the change in shipping expense of the shipping expenses 34, 36, and 38 listed on page 59 of your book. You would take 38 minus 34, a $4,000 difference. And the number of units are listed up above, right above sales. So the units of 5,000 would be associated with the high value, and the units of 4,000 would be associated with the low value. So there's a difference there of 1,000 units. So we divide that. The variable rate for shipping expenses would be the $4 per unit. We'll do the same process, but with sales and commissions expense. So take the high value of sales and commission, 80 from September, subtract the low value of 78, there's a $12,000 difference. And again, the September units were 5,000, July's units are 4,000 when the high and the low values occurred. So there are 1,000 units, the change in activity. So we divide the 1,000 units into the $12,000 high-low difference, and the variable portion of salaries and commissions expense would be $12 per unit. So in the next part, we are determining the fixed amounts, I believe. So the cost formulas are, I think I missed something. The fixed elements would be, what is the total cost at the high level of activity? So for shipping expenses, it's $38,000, and that's in September. How many units were produced in September? 5,000. So if $4 is the variable cost for shipping, 5,000 units, $4 per unit, $20,000 was the variable cost associated with shipping for those units. So the fixed portion would be the difference, or $18,000. Remember our formula. Y equals the fixed cost plus the variable cost per unit times the number of units. We do the same thing with salaries and commission expense to determine the fixed portion. Take the high level in September, 90,000, subtract from that the variable portion, which would be the $12 per unit times the 5,000 units produced, or 60,000. So of the 9,000 total salaries and commissions, 60,000 of it is dependent on how many units are produced. 30,000 would be fixed for that level of activity. The final says, redo the company's income statement at the 5,000 level using the contribution format, the managerial accounting format. What you're seeing there is the financial reporting or external format. So we'll take sales, 5,000 units times $100 per unit. We'll subtract the variable expenses first. And remember from Part A, we know what's variable and what is fixed. So we'll subtract the cost of goods sold, which is $60 per unit times the 5,000 units. We'll subtract the variable portion of the shipping expense, $4 a unit times 5,000 units, and we'll subtract the final variable cost, the $12 variable portion of salaries and commissions times the 5,000 units. So the contribution margin per unit would be 500,000 minus the total variable expenses of 380 for 120,000. Next, you would then subtract your fixed expenses, the ones that don't change with the level of activity. And they were defined: advertising, the fixed portion, all of it, 21,000. The fixed portion of shipping was defined in Part 2, 18,000. The fixed cost or fixed part of salaries and commissions expense was defined in Part 2 as 30,000. And we already said insurance and depreciation expense are both fixed. So the total fixed costs for Morrissey & Brown would be 90,000. You're still going to get a net operating income of 30,000, but the way we subtract the expenses for this contribution format is just different. Variable are first subtracted, then fixed. So that is how you would accomplish problem 116A using the high-low method. And it also looked at this contribution format. Now problem 121A, the other practice, is really that. It's really helping us to define and think about what all these various costs are. Where do they fall? And property taxes, are they variable or fixed? They're normally fixed. Are they selling, administrative, manufacturing? Well, it depends on what the property taxes are. Here they're for the factory. They would be indirect fixed costs in the manufacturing process or product. So they would be included in the cost of the product. Boxes used for packaging detergent produced by the company. Well, that would be dependent on how many were actually being produced. So they would be considered variable, and they're actually being used to package the product. They're a direct manufacturing cost. Salesperson's commission, that would vary dependent on how much they sell. So that's variable, but it is a selling cost. It is not a cost to produce the product. It's a cost to sell the product. Supervisor salary, that's usually fixed, and since it's part of the manufacturing process, it's an indirect, usually an overhead. You can't say how much of his salary was directly associated with a particular product. Exactly. Depreciation on the executive autos, that's fixed and that's administrative. It has nothing to do with the manufacturing or selling of the product. Wages of the workers assembling the computers. Now, that's a direct labor, so they are variable and it's a direct labor for product costs. Insurance for the finished goods warehouse. That's usually fixed, so it's not based on the amount you produce, and it's a selling cost because you have to store it before you sell it. Lubricants for the production equipment will be variable. That depends on how much you're using the equipment, but it's an overhead or an indirect cost of making the product. Advertising costs are normally fixed. They have nothing to do with production, and they're considered a selling cost. Microchips used in producing calculators. Well, if you're making calculators, it's variable. So the more calculators they make, the more cost you'll have overall, and that's a direct material of making the calculators. Shipping costs on merchandise sold will vary based on your sales, and it's a selling cost. Magazine subscriptions for the factory lunchroom. So it's a fixed cost, and it's considered an indirect cost of making the product because you put them in the lunchroom. That's really stretching it. Thread in a garment factory. That's a variable cost. So the more you make, the more you'll use. But it's not a direct material. Like how much thread do you use? It's an indirect or manufacturing overhead. Billing costs. Now you'll see this little asterisk there. That just means it could be put into another category. It could be considered administrative maybe. But it is variable based on how much you sell. You could put it in selling or administrative. So you're not locked in there. The executive's life insurance policy premium. That is a fixed cost, so it's always going to cost the same, and it doesn't change when you produce more. And it's going to be an administrative cost. It has nothing to do with the product or selling it. Ink used in textbook production. Again, how do you measure how much you're actually using? So it's very hard to do that. So, the more textbooks you produce, the more ink you'll use. So the cost will increase, so it varies according to how much you produce, but it's considered an overhead. It's very hard to trace it as a direct material. The fringe benefits of the assembly line workers. So you could see there, it's variable, and it could be indirect or direct. That's one's a hard one. Yarn used in sweater production. Now it's a variable, and if you're making sweaters with yarn, that's a direct material. And finally, the wages of the receptionist for the executive offices. Well, that's usually going to be fixed. It doesn't change according to how much you sell or produce, and it's an administrative cost. So that's a great review of some expenses, some costs, and where they fall as either being variable or fixed, and what category they would ultimately go into. Are they a period cost, selling and administrative, or are they a product cost, part of the manufacturing process, and a cost that would be accounted for there? Okay, so that concludes the two problems I wanted to review in Chapter 1. If you have any kind of questions at all, please post them onto the discussion board.